Well, we did put out our outlooks this week, so we did our credit conditions quarterly forecast round. The one country that really moved the global needle up a bit was China, and that's really because in the previous round, we were kind of struggling with all these forecasts as the trade drama unfolded. We're a little bit less pessimistic about U.S. China bilateral tariffs now. So our APAC Chief Economist, Louis Kaus, raised China's forecast. So now we're a bit above 4% this year, and that was enough to lift the global needle. Basically, the rest of the advanced countries are the same, EM's a little bit more. So it wasn't a huge upgrade of growth.
Right.
It was just a recognition that we don't think the end game is necessarily anywhere near on tariffs, but it looks a little bit less bad for China, so we raised the China growth forecast.
Less bad for China. What's driving that less bad picture outlook for China?
Yeah, it's really just, well, we've got the 6-month pause now, right? Because the de-escalation from the triple-digit tariffs took place, and we're trying to forecast what's happening over the next couple of years. And I don't know if we've got a full extension baked in there, but some of the super high tariffs that we had to take into account last time are off the table. So this is going to be a little bit more trade, a little bit more investment, a little bit, more stimulus in Chinese growth.
How do you make your forecast when you don't know the end game? You don't know what's really driving this. We don't know where we're going to end up in terms of oil prices, the tariff levels by the end of this year. How do you do that?
We've got a ton of uncertainty. Well, the identities, things have to add up, right? Global trade has to be equal to zero and income's equal to expenditure, all that stuff. We've just got a ton of uncertainty around U.S. tariff policy, the role of U.S. in globalization. Now we've got oil price on top of that. So we just do our best forecast. That point forecast is in a sense always wrong. We usually have we call it a confidence band around that. Those bands are quite wide right now, right? Because we just have all this uncertainty. So we put out a consistent set of numbers. That's actually for our analysts. So we have 1,600 analysts globally who have got 1 million credits out in the marketplace. So they need that, consistent macro forecast and narrative. We work with them on this forecast. This is the best shot we have. So this is just our latest publication, quarterly update. We're going to obviously continue to watch things as they develop.
And when you're talking about that wide band here,
right,
do you have a wide band for oil prices outlook as well? I mean, can we trust the ceasefire? What's going on with the ceasefire?
Yeah, well, oil prices before the Israeli-Iran, outburst were actually drifting lower, and our commodities team had, prices going below the global comfort zones, kind of 70 to 85. That's where it looks like consumers and producers of oil are kind of comfortable. We're actually back in that band right now. But I think the worry was your lead-in story was, this Middle East situation still evolving, the Strait of Hormuz is in play. So the risk scenario now is we get another jump in oil. Oil jumped from 60-ish to 75. That's an almost 30% jump. If we go above that sort of the comfort zone of 70 to 85 per barrel, then we may have to look again at the forecast. Oil prices become sort of a tax on growth at that point, right? Because consuming nations would take a hit.
Okay.